When investing and growing your wealth, it is preferable to do so in appreciating assets. An asset that increases in value over time is one that appreciates rather than depreciates. Investing in assets that increase in value is one way to secure your financial future. However, not all assets appreciate in value, and there is no guarantee that your investments will grow significantly over time. However, there are a few investments that have historically been regarded as appreciating assets. What are appreciating assets? When the value of an item rises over time, it is said to appreciate. Real estate is a prime example of an appreciating asset. In general, when you buy a home, its value rises, especially if you renovate it. When an item depreciates, its value decreases over time. This is true for assets such as automobiles. When you buy a car, it begins to lose value the moment it leaves the dealership. Any asset that increases in value is referred to as appreciating. Equity, bonds, real estate, and currencies are all examples. When referring to financial assets that increase in value, the term capital appreciation is frequently used. Most traditional portfolios will include some of these assets. How do assets appreciate in value? Asset appreciation occurs for a variety of reasons. It could be as a result of increased demand, decreased supply, changes in inflation or interest rates. Just because something has increased in value does not mean that the owner of the asset is aware of it. An owner may revalue the asset and include the increased value in their financial statements. This is known as a realization of appreciating assets. 8 examples of appreciating assets. Investing in appreciating assets is one of the most important keys to accumulating wealth. But where do you start? Here are some of the most common appreciating assets that investors include in their portfolios. Remember to conduct your own research, as some of these assets may not be suitable for you. 1. Real estate. Real estate is one of the most popular assets that appreciate in value. You can begin by purchasing single-family rental properties. Also included are multi-family dwellings such as apartments, commercial real estate such as shopping malls or offices, and even land. Property is a long-term investment. These properties will be purchased by investors and rented out. Some people invest by renovating a property and then selling it for a profit. The longer you own the property, the more likely it will increase in value. However, there are risks associated with real estate, such as the 2008 housing crisis. You can invest in real estate by purchasing a rental property. You can also invest through a REIT, which stands for Real Estate Investment Trust. These are businesses that own and frequently operate a variety of properties. They are frequently traded on the public stock exchange, making them accessible to ordinary investors. It is a simple way to invest in real estate. Furthermore, there are no large upfront costs or the need for a mortgage. 2. Stocks. Stocks are another type of asset that appreciates in value. When you purchase equities, you are purchasing a share of a company in the hope that its value will rise over time. You can even obtain voting rights, and some businesses will pay dividends to shareholders. Investing in stocks can be dangerous, particularly if you are investing in new and emerging stocks. Most experts advise investing in a diverse portfolio of various types of stocks. This way, you can mitigate any potential market loss or volatility. It's also a good idea to do some research on stocks before investing. Stocks can be purchased through any investment platform or broker. You can also invest in a collection of different stocks through an exchange-traded fund, or ETF, which may reduce your investment risk. You'll also broaden your exposure to hundreds, if not thousands, of companies across multiple industries. There are even ETFs dedicated to specific industries or even sustainable businesses. 3. Bonds. Bonds are a good addition to a traditional portfolio, even if they appreciate slower than stocks. A bond can be debt purchased through a mutual fund or a loan to a government or private company. In exchange for the loan, you will receive a fixed interest rate that will mature on a predetermined date. Bonds come in a variety of forms, the most well-known of which are U.S. Treasury bonds. Bonds can be purchased directly from the U.S. Treasury Department or through your stockbroker. 4. Fine art. Collector's items, such as fine art, are also valuable, but they can be costly. And, unless you purchase art from a well-known artist, it is difficult to predict whether the piece will appreciate in value. Fine art is diverse, but it is often prohibitively expensive to acquire. Fine art can be purchased at auctions and art galleries. There are even some platforms, such as Masterworks, that allow you to buy shares of an artwork, making it more accessible to the average investor. 5. Certificates of deposit. Certificates of deposit, or CDs, are similar to bonds in that they provide a fixed return in exchange for keeping your money in your bank for a specified period of time. They have a lower risk profile than other types of investments. They, on the other hand, have lower returns. CDs can be purchased at your local bank or credit union to invest in. When you buy a CD, you are putting your money in the bank for a set period of time. When the date arrives, you will receive the money plus interest. The longer you keep your money in the bank, the higher the interest rate. However, the interest may not provide as high a return as other appreciating assets. Furthermore, the money is locked away for that period of time, so you won't be able to access it if you need it. 6. Commodities. Commodities are a broad investment category, but they are yet another asset that grows in value. It could also be an excellent way to diversify. There are several commodities to consider, including gold, corn, oil, wheat, beef, and natural gas. Commodities, like stocks, are a risky investment because prices fluctuate in response to natural disasters and political events. Retail investors cannot invest in commodities in all brokerages, so you'll have to look for one that does. Commodities can be purchased through ETFs or by purchasing stock in a commodity company, such as an oil company. 7. Alternative investments. Alternative investments are another broad category of asset appreciation. Wine, for example, is regarded as a viable alternative investment. You can also consider investing in collectibles. Consider trading cards, non-traditional tokens, or even sneakers. Alternative investments, on the other hand, can be riskier than commodities, stocks, or real estate. If you want to invest in this, make sure you only put a small portion of your money into it. 8. Cryptocurrency. Cryptocurrency is a popular asset that is increasing in value. Cryptocurrencies have skyrocketed in value over the last decade. Popular cryptocurrencies such as Bitcoin have amassed billions of dollars in market capitalization. However, the market is extremely volatile, making it a very risky investment. If you want to invest in cryptocurrency, you can do so through apps like Coinbase and eToro. It's worth noting that many of these apps have higher fees, more than you would pay if you invested in stocks, so factor that into your calculations. Expand your wealth with appreciating assets. Investing in appreciating assets is one way to accumulate wealth. Real estate, commodities, bonds, stocks, and even cryptocurrency are all rising in value. Each has its own set of risks and benefits. Before you invest, conduct your own research or consult with a financial advisor to ensure that the appreciating asset is appropriate for your portfolio and personal circumstances.